Hey, welcome back to the channel. Today I want to talk about capital allocation and financial statements. So we're going to be talking about one of the three major financial statements that you can have. The three major financial statements being the income statement, the balance sheet, and the cash flow statement. Now, which one do I consider the most important? The most important financial statement is the cash flow statement. And you'll hear that a lot, especially from proponents of Robert Kiyosaki's school of thought. And it is true. But I don't think that it's true for the reasons that he gives. So let me talk a little bit about capital allocation. I've talked about this before. A company has only a couple of different things that they can do with capital, right? Financial capital. The only 5 things that they can do with money, essentially, is they can pay down debt, they can repurchase shares, they can give a dividend, they can reinvest in the company, or they can make acquisitions. What I want to point out is that most of those activities will not fall on an income statement. They will not fall on a balance sheet. Where they're going to fall is squarely on the cash flow statement, right? So let's go through each of these really quickly and to show you that yes, in fact, this is on the cash flow statement, and the cash flow statement is the statement of how the business is allocating capital. And capital allocation is the number one thing that's going to determine your returns on a stock over a long period of time. What your goal as an investor is to do is to find a business manager who is very, very good at allocating capital. All right. So let's go through this really quickly. And in no particular order, paying dividends. That is going to be found on the cash flow statement under the cash flows from financing, right? It's a charge. It's going to be a negative number because they're literally just giving cash to shareholders. Similarly, repurchasing shares, right? That's also going to you're also going to find that on you're going to find that in 2 places really, but the cash charge is going to be on the cash flow statement again from the and this is going to interact with your balance sheet mainly, but you're going to see it on the cash balance on your balance sheet for the dividends as well. That's going to go down, right? Similarly, the cash balance is going to go down, and so is the share count when you repurchase shares. That's also going to be found on the cash flow statement. That charge is going to be found there under the financing section. The third one, so those 2 are very similar because they're just returning cash to shareholders. And they don't really matter all that much in terms of capital allocation other than here's your money back, right? It's a company returning funds to the owners. The dividends don't actually concern me that much in terms of capital allocation, because that is just, and I'll give my thoughts on dividends a little bit here in a little bit. But the share repurchases, you want to see a company that's buying shares when the price is low and potentially selling shares. You want the business to be acting like you. All right. You want to see them buying low and selling high, right? So I don't necessarily fault a company for diluting shareholders. That's kind of a strange thing to say if they're diluting shareholders in the right ways, right? I'd prefer them not to dilute shareholders, but if the price of the stock is stupid high, you've got PE ratios through the roof, well beyond what a discounted cash flow model would say that the business is worth, and the company's issuing shares. That makes a lot of sense, right? When GameStop exploded last year in price, and everybody that had started buying it when the price was going up to create the short squeeze, and GameStop started issuing shares, right? I did not blame GameStop. Frankly, if I had been the manager of GameStop, the CEO of GameStop, and I saw the price action happening there in the stock, I would have diluted as well. I would have pumped money out of the market. I would have said thank you to the shareholders for pushing the price way, way, way past its intrinsic value, and I would have started pulling cash into the business to survive for another day. That's what the market was signaling to the CEO that he should have done, and he did it, right? I don't blame him for that, right? Diluting shareholders in that situation was the right call. So I don't necessarily think that that's a terrible thing, right? To dilute shareholders if it's done at the right times for the right reasons. Okay, so enough of that. Let's move on to the third piece of capital allocation that you might want. So number 3, let's see. We'll go, I know I said this one last previously, but let's go with making an acquisition, right? You can make an acquisition. And again, don't really fault anybody for doing that, right? It's a way to grow the business. It's a way to reinvest into the business, right? You're buying some other piece of another business and bringing it home, right? You're taking the cash flows from this business and you're bringing them into your business. There's nothing wrong with that, right? Again, similarly to share repurchases, what I want to see is that they're paying less for the business than it's worth, right? Just like you investing into businesses, you should be buying businesses at less than what they're actually worth. And so I think that a company buying another business should be doing the exact same thing, right? If they can buy the business for less than what it's intrinsically worth, then it's a good deal and they should move forward with it. If they can't, then it's a bad deal and they should stop and reconsider their life choices, right? So those are 3 ways that you can do that. The 4th way that you can spend money, let's see, we did dividends, we did share repurchases, we did acquisitions, paying down debt. Very, very simple idea. Business has debt, you're going to pay it down, right? Pay down the principal on that debt so that you don't owe as much. Simple, right? Except for it kind of becomes sort of this push-pull thing, right? So my thoughts here are kind of this thing, like some businesses should leverage up to enhance returns on equity for the equity holders, the shareholders of the business. And so not all debt is necessarily evil for a business. What I would say is that there should be some sort of target around debt that that the CEO of the company, the CFO, the CEO, that team is trying to hit, that management team is trying to get to. They're trying to get and maintain within a certain range. I love it when I hear management talk about, hey, this is the range on our leverage that we're trying to hit. We're trying to be between these two numbers. That tells me that they get debt, right? They understand what they're doing with debt. And if they're doing that, right, and they're sort of trying to maintain that range, if things get way out of whack, or if they have a big opportunity and they go outside of that range for a little bit, that's okay. I'm okay with that, right? Taking on a little bit of debt to make an acquisition at a good price, or to do something else at a really good price, makes sense, right? If you can get a 5% return and borrow at 2% to do that thing, you net 3%, right? That's a good deal. And that's something that they should do, right? It makes sense to do that deal. So if they borrow to get into that deal, it's very similar to you buying a house, right? You should start paying. Once you're in the house, once you own the house, you've borrowed and mortgaged to get in, there's very little incentive to stay in that debt, right? The only incentive that you have is that you want to leverage. So if they go outside of their comfort zone in terms of leverage, you're going to want to pay that back down, right? And you're going to want to pay that down with funds that are cheaper than the debt itself. So that's the fourth thing that you can do, right? Just pay down debt. The last thing that you can do is reinvest in the business. This is the most common, the cheapest, the best way to use cash, generally speaking. What you want to do, what the CEO, CFO, the C-suite team, we'll call them, the management team, should be doing is that they should be reinvesting in the business, and you're going to see that also on the cash flow statement. You're going to see this under the investing, right? This is going to be purchase of property, plant, equipment. You'll also see this in on the income statement through the research and development charge, because you don't depreciate and you don't capitalize research and development costs per GAAP standards. Those end up on the income statement as an income expense, as an expense, right? They don't show up on the cash flow statement. So that's the one little exception here, is research and development costs. They can end up in the quote wrong place in terms of capital allocation, right? Everything else other than research and development costs, they're going to be on the cash flow statement, and specifically where they're going to land are either in the investing or the financing columns of the cash flow statement. And if you go through that, you'll also see, there are 3 ways that you can get money into a business. Actually, 4. The 3 things that the 3 main ways that you can get money into a business is you can earn it, you can borrow it, or you can sell shares, right? The 4th way that's sort of selling shares is to spin off businesses and sell them off and whatever, right? You're selling a hunk of the business itself, which isn't necessarily a bad thing, but I sort of combine that with selling shares because you're selling pieces of the business off, right? Most people do, but technically it is a fourth option. You can sell lines of business off, right? Which doesn't dilute the shareholder, but it does make the shares less valuable. So in a way, it kind of does dilute you. But those are the 4 ways, 3-ish, 4-ish ways that you can get money into a business. And surprise, surprise, all of those things sort of land on the cash flow statement as well. So that cash flow statement is really, really important to understanding how the business is allocating its capital. And that's the thing that I wanted to sort of share with you. And let's go back for a second on dividend repurchases or dividends. Dividends should be the option of last resort. I like dividends. I'll take your dividends, right? If you're giving dividends away, I'll take them, right? As long as I'm buying the business at a reasonable price, that's fine, right? Dividends are great. Don't have any complaints about people giving me money, right? But the thing that you want to see with dividends is that you have exhausted everything else, because you are not going to get any sort of return on a dividend, right? That is literally just giving the money back to the shareholders. So there's literally no other way. You're basically saying there's no other way the business can generate a return on this cash. So reinvesting in the business, you've driven that down below whatever it's worth. You drive, basically you want to keep investing until it's no longer profitable. You reach the risk-free rate within the business, right? So the management team has driven that down. The debt that they're seeing, they've paid that down until they're comfortably within their target range. Great. All right. Let's see. So we're done reinvesting in the business. We're done paying down debt. What else do we have to do with this cash? We can buy a business. Is there anything cheap enough that makes sense for us to invest in? No. Okay. Well, then we're not buying a business. Last thing that we can do is repurchase some shares. Oh, hey, our share price is stupid high. We're not going to do that. Shareholders, here's your money, right? That's it. That's when you pay a dividend. And so if you can't reinvest the money, then there's no other option. Give it back, right? That's it, right? So that's sort of the idea. And if you start looking at returns on invested capital, or returns on incremental invested capital, you can do something very similar with acquisitions. You can do something very similar with other things. You can do it with share repurchases. You can do it with all these other things, returns on incremental, whatever, right? And you can start looking at that and you can say, how well are these businesses actually allocating their capital? And then you just go and you can start making choices about whether or not you want to buy this, right? You do your valuation. It makes sense to buy it. They're really good at allocating the capital, as you can see on their cash flow statement. You think they're a good capital allocator, buy it, right? And that's where I focus my research on, is that cash flow statement, because I think it makes the most sense. Because it really does boil everything down to the most important things. Now, the income statement is going to tell you a lot of things. The balance sheet's going to tell you a lot of things about the business, right? You want to know, is this company, do people buy their product? Is this company drowning in debt, right? These other statements are important, but I think that in terms of where the business is going to go, the cash flow statement's the one that you want to look at. All right, that's all that I've got for today. It was kind of a longer video, so enjoy and stay rational out there, my friends.